Let's get into this. Bull market, kind of going better than most of us expected. And then ahead of the Fed minutes later today, we hear from Adriana Kugler saying she'd like to see some more cuts. In your mind, does that keep the rally going?
I think it could keep the rally going, but we have to be realistic here. The market is expecting these cuts to happen. And so I don't know that the market necessarily is expecting 50 basis points and 50 basis points again to be a good thing, but we're definitely expecting more cuts through the end of the year. And so I think that's probably baked into most traders' expectations at this point.
All right, so it's baked into expectations right now. I want to talk about earnings. We're about to kick off earnings season coming up on Fridays when the big banks report. I'm just looking at the earnings estimates. LSEG sends them every week, and you keep seeing the estimates. We're going to show a graph in a second. They just kind of keep ticking on down. So if you're saying the market's already expecting those cuts and the earnings estimates are going down, then what keeps this rally going?
Yeah, so I actually think, to your point about the big banks specifically, it's a mistake to think about them just in terms of what the net interest margin is going to return you as a shareholder. I know that that's typically the metric that we care about when we think about the GSIB specifically, but I think in this case we should be paying more attention to the fact that M&A activity is likely to pick up following the November election. Regardless of which administration comes in, it's probably going to be more friendly to the business community than the Biden administration has been. And so if you're an investor in the big banks, that's probably the reason you want to be holding those shares, not necessarily worrying about that interest spread going forward.
You know, Malcolm, you mentioned the financials. I know one of the areas you're looking at for opportunity is the XLF ETF. It's the bank ETF. Since the announcement that the capital requirements, the Basel Endgame, I don't want to get too much in the weeds in this, but the proposal is now about half of what it was supposed to be before. The banks have actually underperformed. Wasn't that supposed to be a catalyst for the banks? I mean, what's going on here? Why are you still bullish? Because you said it's already priced in that we're going to get these cuts. So the benefit of the cuts should already be priced into financials. And then lower capital requirements doesn't seem to really help out financials. They're underperforming by quite a bit. So what are you seeing? What opportunities are you seeing?
Yeah, again, I think investors in banks have traditionally focused on one metric, which is that net interest margin, right? It's the spread between what the bank actually earns and what they pay out to you, their customers. And so I think that focusing on it based on that traditional metric is the reason that investors in financials may be getting this one completely wrong. If you just think about the GSIBs like the Goldmans of the world, the Morgan Stanleys, where they really make their money is in the markets where M&A activity is going well. We got IPOs happening. We've got acquisitions happening. Those are the things that are likely on the come. And I think that it's a mistake to just focus on that interest spread and being able to play those rates.
And you're saying that's why it's underperforming. People are overemphasizing the benefit to net interest income and overlooking some other parts of that financial story. Okay, I want to get to how you make your business, getting people to invest. So you're one of many people that's come on this show and said money's about to come out of these money market funds. It's going to be put into the market. But when you look at the trend, it seems like the money market funds are just growing. I'm actually looking at the latest data from ICI. Money market funds, they've grown actually 5% since the start of Q3. They're now almost $6.5 trillion. Why do you think the money is going into money market funds as opposed to going out, even though everybody seems to think it's going to come out?
Yeah, I'm actually concerned that the money has been staying in money markets for as long as it has, right? It's been a great trade for the last couple of years if you've been an investor who took some gains somewhere along the way and said, I'm just going to hide out here, earn 5% risk-free and see what happens. I know that some of that money is investors who have moved those dollars from like a B of A or a Wells Fargo just seeking higher yields in general. But the majority of it is likely folks who have taken some profits along the way. And I think the big mistake that investors are likely making is thinking that the party is going to keep on rolling, even though folks like you and I have been saying for some time now, okay, rates are on the come down. It's time to actually focus on what the strategy is to move away from that. And so it's not really an if, but a when. And I don't know that investors are taking that as seriously as they should be, just looking at the fact that, like you said, those numbers have been ticking up instead of down.
You know, Malcolm, we got to go. I know you're also looking at Zscaler. Just very quickly, why'd you add that on September the 26th to your portfolio?
Yeah, to me, that's going to be the more likely winner of any trade-off out of CrowdStrike, not necessarily the SentinelOnes of the world who would love to have you believe that they're the next in line. And so I think Zscaler is probably the best possible way to trade any trade-off coming from CrowdStrike's mishap.